The U.S. housing market is hitting a new low. Home sales are on track to have the worst year in decades. You may remember when the housing bubble burst, but today's current market appears to be deflating. Last year, home sales slid 19%, becoming the worst housing market since the mid-90s. And you may remember when the housing bubble burst, but today's current market appears to be deflating. Last year, again, home sales slid 19%, becoming the worst market since the mid-90s. But the market was expected to bounce back this year, only it did not. Instead, falling another 3.5% since this time last year. The reasons not necessarily surprising. For anyone who happens to be shopping for a home right now, there is number one, low inventory. There is soaring property value, and of course, those high mortgage rates. Now, prospective home buyers are playing a game of chicken. They're waiting for a reprieve in the form of maybe another cut or movement from the presidential election. So let's bring in Dan Frio, a mortgage advisor and host of Rate Update with Dan Frio on YouTube. Dan, great to see you. Thank you so much for your time. So a lot of experts, economists, real estate executives expected sales activity to tick up this year. It did not. What are the ripple effects?
It's if you understood kind of what happened in 2008, there was a dynamic back there that isn't in play today. But what we're seeing right now is so many people refinanced over the last few years at rates at like 2, 3, 4%. Those people are kind of locked in. Like, for example, in my situation, if I sell my house now, I have a fixed rate at 2.6%. So if I went and bought a new house now, it'd be that much more. So that's what's happening right now. And a lot of people, what I talk about on my show daily is exactly this. What's causing mortgage rates to go up. So here's what you're seeing. The people with existing homes, they're not selling because they're locked in at that rate. You have builders, and we focus in on builders every day, what the building permits look like and everything else in that area. Those aren't coming up as well. So we have a lack of inventory, and it's truly there. So I've been saying for the last 2 years, we're going to have a completely stagnant market because, of this. You're not going to see that crash. Well, you might see it in areas such as, especially down in Florida where they had the hurricanes and things like that right now. But most of the country, you usually have a crash, if you think about it, in anything. If you think of stocks or bonds or car prices and even home prices, the only time you get a crash is when you have an excess amount of inventory. So what we're seeing right now is inventory is ticking up, but it's nowhere close to even where we've been in the past. So right now, that's what's causing the home prices to stay stagnant or even increase a little bit. And then on the other side of the frame, mortgage rates, since the Federal Reserve cut rates on September 18th, rates have been up every day since then. And it's a bond issuance problem that we have right now.
All right. So Dan, being that so many people predicted incorrectly, when do you think things will actually bounce back? And how much do you think the results of the presidential election could influence what happens?
I try not to get political. A lot of people are like, okay, we know which way you swing. The deficit is detrimental right now. And it's what's happening with mortgage rates is this, and a lot of people don't understand. It's the bond issuance. So for example, our country, we have a deficit. Okay, what is a deficit? Well, a deficit means you don't have enough money to pay your bills. So like me and you, if we have a deficit, we put it on a charge card. Okay, what the government does is they issue bonds. Okay, so you have a huge glut of bonds in the market. We have the federal deficit right now at $35 trillion and growing daily. And then you have a lot of the carrots that people dangle in front of your face, like, you'll get a $25,000 credit to buy your first house and things like that. We don't need the government continue to give things away. That's a big part of this. And then another part of it is the world. You have China, Japan, Germany, all these other countries issuing a ton of debt, and that's hitting the market. So what investors are choosing right now is they're looking through all this debt that's out there, and they're picking the things with the highest security and the highest payouts. And that's why if you're seeing mortgage rates, think of it, if you bought a government bond, a U.S. government bond, there is 0% chance of default. If you bought a mortgage bond, and that's how mortgage rates are created, there's default. Well, if you have the same rate on each one of them, investors are going to choose the one with no default. So that's what's pushing up mortgage rates to get that yield that investors want or need to buy mortgage bonds. So that's increasing mortgage rates, making it even tougher. And then you have insurances mortgages. If you look at the PCE and the CPI, insurance, especially on homes, I think they're up 50% year over year. So that's also, causing the prices of homes or your payment to be out the roof. And I get it. So I've been calling the last 2 years. I'm like, the market's going to be stagnant. You have all these people landlocked on their homes. You don't have builders coming to with their supply. And then also the mentality with people, they're used to seeing rates 2, 3, 4%. Now, when you see 6 or 7, you kind of freak out.
Oh, yeah.
So that's the whole thing kind of in a nutshell.
Okay. Thanks for watching. Go to joinnn.com to find NewsNation on your screen. And don't forget to click the red subscribe button below to get more of NewsNation's fact-driven, unbiased coverage.